I love talking about Meta stock because it's such a great learning experience for investing. We talked about Meta stock and we liked it sub 250 and we started buying it and it just went to 88 and people are like, you suck, 84, you suck, you're an idiot. And I'm like, okay, that's fine, but we believe the stock is worth something. All of a sudden, fast forward and it's up to 290, 300 and there's no hello. Now, it doesn't mean Meta stock is worth it today. But the point we're trying to make here is stocks can fluctuate. And what we're trying to teach on this channel is fundamentals. How to buy a company even when the stock is falling, but the fundamentals are still in place. There's all these stories about why a stock sucks. And remember, the stories follow the stock price, not the other way around. When the stock was falling to a low of 88 or whatever it was, everybody was saying how bad a CEO Mark Zuckerberg is. Now that it's back to 300, look how smart he is. He's brilliant. Hello? Come on. Now in this video, guys, we're going to go over Meta, some of its higher level metrics, some news, some bull and bear cases, a comment or two from our past videos and what our users have commented on. But we're also going to go over analyst estimates, and we're going to finish it off with our stock analyzer tool, which is probably what you care most about. It's the tool that'll tell us what price to pay for Meta based on our assumptions about the future, because every investment is the present value of all future cash flow. And we're trying to teach that process. So whether you're a beginner or an advanced investor, we have something in this video for everybody. Don't get intimidated. I was intimidated at one point. Every single one of our 200,000 plus subscribers at some point, and probably still are, intimidated in some fashion. But it's about learning, because the more you learn, the less you will fear. And that's what's important. So Meta stock, the company is currently market price of $745 billion. What this means is if you wanted to buy every share outstanding, it would cost you $745 billion. Now, guys, the enterprise value is $765 billion. This difference is essentially their debt. Not much there. Because here's what I love. They have about $20 billion of net debt, and they have 5-year average free cash flow of $25 billion. So they can essentially pay that off in 1 year. That's awesome. How is that important? Well, let me ask you this question. If you had $10 million in debt right now, would you be more or less likely to go bankrupt? Probably a lot more likely. Same works for a company. The more debt they have, the harder it is to service and the harder it is to stay in business when times are tough. And every business will hit tough times. All right. Their 5-year PE is 27. Their current PE is 33. Seems kind of high. But if they can generate growth on their earnings, not just revenue, earnings at a higher rate, then that could be a low number. Profit margin of 19%, but look at this. That's their last 1 year. In the last 5 years, their average profit margin is 28%. Why such a big drop? Well, for one thing, the metaverse costs them $10 or $12 billion a year. They're making this big investment in the metaverse, and maybe it doesn't work out. But if it doesn't work out, guess what? They scrap it, and they increase their profit margins like that. That's a big reason I'd like Meta. All right. Look at this gross margin here. 78%, almost 80% gross margin. What is gross margin? Gross margin is for every extra dollar they sell, how much goes to the bottom line to pay taxes? 80%. That's huge. So they brought in an extra $1 billion they didn't account for this year. That's $800 million at the bottom line. They got to pay taxes on it, so call it $500 million left over in the bottom line. Companies that have a high gross margin, if they can, even if they can only increase their revenue by a few percentage points, it can really add a lot of profit to the bottom line. That's what's awesome. All right. Another thing I like, 5-year return on invested capital, 15%. This means that the money they invest in the business gets a high rate of return. The average in the market is 9 or 10%. The higher this is, the bigger the moat there is, and the faster they can grow their earnings. That's what's key. If they can grow their earnings at a fast rate, you should be willing to pay a premium for the company. That's why we look at return on invested capital. It's the money, the capital invested in the business through debt and equity. What return do they get on it? That's what's key. All right, let's go check out their 8 pillars. So guys, remember, if you have our software, you can customize the pillars up to 12 pillars and 4 quadrillion different variations. But right here, guys, 2 X's. Everything else is a check. The 2 X's are valuation metrics. The price to earnings ratio is 27 over the last 5 years, and the price to free cash flow is 29 over the last 5 years. Those are high numbers. But again, if they were able to quadruple profits the next 3 years, would you pay this price? Of course you would. All right. So let's go over some news on Meta. Guys, Threads is failing. It was like the fastest app to 100 million users, and it has absolutely sucked. And it's now down below 10 million active users per day. Let's see, a bull case. Facebook accounted for 53%, just the Facebook ad, not including Instagram, accounted for 53% of all social media website visits as of March 2023. Instagram was 13.9%. Twitter was 16%. So they own 2 of the top 3 social media sites. That's incredible. Facebook Reels and Instagram Reels has grown from $3 billion in revenue to $10 billion in revenue, while the amount of Reels played on Facebook and Instagram have increased from 140 billion per day to 200 billion per day. Guys, major revenue potential for Facebook on that one. Major revenue potential. That's the good stuff. Okay, now 2 bear cases. Though the stock has rallied, a lot of the company spending concerns remain, with the CFO projecting higher infrastructure costs in 2024. And then the other bear case is the one I told you before. Meta Threads saw 100 million users in a week before falling to 23.6 million, and daily time spent fell from 21 minutes to 6 minutes. That's bad. 6 minutes per day on Threads. Guys, I don't even go to Threads. I have a Threads account. I started it. I never did anything with it. And the unfortunate part is I can't delete it now, because if you delete it, you delete your Instagram. So sick prank there, Zuck. So here's a comment from one of our users. Just doing stuff. My life would be so different if I would put my cash savings in a Meta at 88. I think about that all the time. Well, I like the fact that he mentioned this. And the reason I brought it up is, guys, it's impossible to pick the bottom and top of anything. That's impossible. We don't know where Meta was going. But guys, you can never, when you buy a stock, you're never going to buy at the low. Your permanent purchase is not going to be at the low, and your permanent sale is not going to be at the high. Just accept that. That's why we're trying to teach a process here. Because if you have the right process and you buy stocks for the right reasons, then you will embrace the stock going lower. You will embrace the stock going lower. That's what we want you to do. We want you to sit there and look at an up day and go, oh, and we want you to look at a down day and say, yes, because that's what's happened for me. And you can do that too. It's just about reprogramming your brain. And that's why you and the 200,000 other people who subscribe to our channel can learn this very trait. All right, so let's look and see what analysts are saying about Meta. They're expecting $13.70 per share in profit this year, increasing to about $18 in the next 4 or 5 years. Okay, nothing sexy, but it's, I mean, some drops here and there, but that's what? That's $5, that's $4.50 on that, 30% growth over the next 4 years, 6 or 7% growth a year. Nothing special, nothing huge, but it's still pretty decent for a big company. Let's look at their revenue growth. Again, nothing huge. 135 to 178. Sounds like a big number, but it's not as big. By the way, guys, here's an anecdote for growth. Kevin Costner is getting divorced right now. And there was an article written the other day about how he crushed it in his net worth. He went from $100 million 20 years ago to $400 million today. Guys, that's not crushing it. That's 7% a year. And all along that way, he also made probably tens of millions a year on his income. But that's the point. 4x over 20 years sounds like a big number, but it's not. That's why we love the idea of slow and steady growth, matching the market. If you're just able to find good stocks that can even match the market, you will do very, very well. That's the key here. But that's when I show you, if I told you 135 to 178, you'd be like, oh my God, that's huge. When in actuality, it's not really that big of a deal, percentage-wise. Let me see what the actual number is. So 178 divided by 135 to the power of 0.25. Yeah, 7.15% over 4 years. 1, 2, 3, 4. Yeah, okay. Nothing insane, but 7% for such a big company, that ain't bad. So if you can pay a reasonable price for Meta, you can do very well just letting it grow. The question is, are you going to let it? Now remember, Facebook owns Facebook, Instagram, and WhatsApp. There are 8 billion people in the world and 3.5 billion people on those 3 apps alone. And they haven't even started monetizing WhatsApp yet, barely. There's a lot of potential still. And there's a lot of potential for Instagram and Facebook ads because of international users. The average user in the US is around $40 per user in revenue per year. Foreign, overseas, is like $5 or $7 per user. So there's a lot more growth as the world becomes wealthier and wealthier. That's the big key there. All right, so it leads us to our final question. What price will I pay for Meta? Now, I'm gonna pull up what we did in the past. The last time we did a Meta analysis was July 26th at 427. So in our software, I can look at the history of all my times looking at Meta. And that's what I love. I can pull it up now and pull up what we did in the last video and see if I still agree with these assumptions. So 1, 5, and 10-year ROIC here, pretty good. So I'm going to do revenue growth, profit margin, free cash flow, assign an ending PE and price to free cash flow. What multiple do I think it'll be selling for in 10 years? That's very simple, okay? I'm just going to pick it. 15 is the market average. I should go higher for a big moat and big revenue growth, lower for the opposite, okay? Now, for revenue growth, I did 6, 10, and 14%. I actually think 10 might be a little high right now. So I'm going to alter this. I'm going to go 5, 8, and 11%. So I'm going lower than I did before. Profit margin, 24, 28, and 32. Same with free cash flow. I'm okay with these. I am absolutely okay with these because they did about that in the last 5 years, even though their low numbers are right here. But I think in that time, Meta will be figured out, but they still have a lot more. The metaverse will be figured out. Is it going to work or not? But they're still going to have a lot more growth potential for the users they have on their platforms. So I'm okay with this profit margin. It actually could go much higher because of such a high gross margin. Remember that 80% gross margin means as they drive more and more revenue up, they're adding more and more to the bottom line, which will drive up their profit margin and free cash flow. Now, what PE would I put in? I put 16, 19, and 22 before. I'm still good with that. I can justify a higher PE in this. They own the social media market. They own it right now. And finally, for desired return, I did 10, 12.5, and 15%. Now, I'm going to keep that right here. 10, 12.5, and 15, because I already beat up the company here on the low side. So I'm okay making, if this low side occurs, I'm okay making 10%. If the middle assumptions occur, 12.5, because I want a reason to buy this company. This is essentially my margin of safety. The higher and higher my assumptions, the more margin of safety I need. And 15% for the high side. Because the harder it is to hit these achievements, I got to get paid for that. So 15% return. The more return, the less price I pay. So guys, you've seen a lot of the software. There's so much more to it. All these tools above, everything is available in our software, on the palm of your hand, in our mobile app that has everything from the software, but most importantly, our community of like-minded investors, because investing can be a lonely road. This allows you to engage with thousands of other investors at any given time to provide input and feedback on your investment ideas. Everythingmoney.com, go check it out. We're running a special, $10 off per month, limited time. So go check it out right now. For about $1 a day, you can have all of this software. It is a no-brainer. Here's our prices. A low price of $205, high price of $425, a middle price of $300. Guys, if you pay today's price of $288 and the low assumptions occur, you're gonna make about 5.5%. If the middle assumptions occur, you're gonna make 13%. And if the high assumptions occur, you're gonna make 20%. There's a lot of potential here. Don't buy it just because of this, but join our community, give yourself the tools to make better decisions. Everythingmoney.com. Thank you very much for your time.